Today is April 17, 2024. Thank you for watching. My name is Ben Reppond. Welcome to my YouTube channel. If you watched my video yesterday, you know that what I said was, from everything I can find, the view of the equity market is positive. Bonds are different. I think bonds are in terrible shape. But as interest rates seem to head up, bond prices tend to shift down, which as interest rates go up, so do bond yields. So therefore, bond prices go down. So as I look at this, my view is positive, and from everything I can read. So on equities. So if you're in a balanced portfolio, equities being positive, bond, the other component, being negative, good luck. I think that, my view of buy and hold portfolios is negative, and the 60-40 portfolios is negative. The decline of bonds and the rise of interest rates and bond yields going up, that's a negative. So, I think there's a lot of traditional portfolios that have very little return for this year, and because of the bond component. But anyway, that's my view of the market, and I'm going to jump into the dashboard and take a look at the component parts of the market for particularly this last week. So the first chart I want to show you is these are the equities, 6 equities and 1 bond, ETF. So the equities, the S&P 500, the Dow, the NASDAQ, etc. So you can see on the far right, you can see those that are negative to the first column, 20-day moving average. They all, because it was a negative week, they all have dropped below their 20-day moving average. And the next you see the 50-day moving average. 4 out of 7 are below their 50-day moving average. And then the 100 and 200-day, they're all positive except for bonds. Bonds is negative to all of them. Now we go over to the S&P 500, and you can see the 11 component parts of the S&P 500. These are the sectors, the component parts inside of the S&P. So when you look at them from top to bottom, the top one from the pink box in the center of the page, pink box is energy. Energy is up 14% year to date. From there, you drop down to the second best ETF sector, and that is industrials. These are defensive type sectors, up 7%. So you drop all the way from 14% down to 7%. From that second one, if you go over to the right side, you see that first set of dots. You see energy's positive for the week, and it's still above its 20-day moving average. All the other 10 below that are below their 20-day moving average. And when you go over to the right of that, 8 out of 11, vast majority, are negative to their 50-day moving average. And there's even 3 out of 11 that are negative to their 100, and 2 out of 11 that are negative to their 200-day moving average. So this was a negative week for virtually all sectors, and energy stays at the top. Okay. This is the chart. It's a weekly chart. 1 move equals 1 week of the S&P 500 represented by the ETF SPY. So you can see over an 18-month period of time, year and a half, that it generally, I put the black line on, you can see generally goes up. However, at the far right of the chart, you can see that for the last 2 weeks, it has ticked down, and represented by, a week ago and then this past week. But it's still well above its 20-period moving average and is still moving in an upward direction. When I take the S&P 500 and split it apart into growth stocks and value stocks, just two categories, growth and value, and compare those on a relative strength basis, this is what I get. I put growth as the numerator, value as the denominator. So when it goes up, it favors growth stocks. Whether the market is negative or positive, it does not matter. It's what component part is in favor. And in this case, growth is in favor. And I put 2 lines on. One is more of an intermediate term line, which is the black line, to show you over time, in my opinion, an intermediate term period of time, you can see that the growth stocks have in fact had a favorable direction. There's up and down periods, but in general it's up. Then I put to the right on the right side of the chart, I put a red arrow to show the short-term direction of the market, or of the growth stocks, which is favorable. So whether intermediate term or short term, growth stocks are more in favor than value stocks. Now, there are periods of time, you can see those, where value stocks have been more in favor. And that means when that line goes down, that favors value. They're more favorable than growth. But for now, I would say growth is more in favor than value. When I compare on a relative strength basis the S&P 500, which is the 500 largest companies, to the Russell 2000, the 2,000 smallest companies, IWM is the ETF, when I put those on a relative strength chart showing large cap, S&P 500, as the numerator, and IWM, the small cap, Russell 2000 small cap index, as the denominator, when it goes up it favors growth, or S&P 500, large cap. When it goes down it favors small cap. So you can see, just as in the past chart, you can see that general direction, short term and intermediate term, that the larger companies are more favorable than smaller companies. Then I get away from relative strength and I go to absolute. So the absolute chart for the bonds, the long-term government bond, is down. It's down for the week, it's down for the last couple of weeks, it's down for the last 4 years, it's down. So this is a part, or it represents a part of traditional portfolios. Traditional portfolios will include typically some portion of long-term government bonds. They may include intermediate term, they may include corporate, but this is a representation of what that probably looks like. So the component parts, the equity piece in portfolios, are up, generally speaking, and the bond component is down. So you have things going in opposite directions, which makes traditional investing, traditional buy and hold portfolios, anemic, negative, barely positive, etc. So traditional investors, of which you may be one, usually get frustrated about now. They see that, oh yeah, bonds do protect me, sort of, except the last 4 years, but when the market goes up and I want equity participation, I am neutralized. I am diminished by the negative component of bonds. And so it's like, why don't I have some kind of positive return for the year? And so this last week, for example, the last couple of weeks, equities are down, bonds are down. So bonds didn't do anything to really protect you in the last couple of weeks, at least not the long-term government bond. So anyway, this just gives you an indication of how poor bonds are, and it underscores, Warren Buffett's philosophy is, I would never own a bond at any duration, and I can understand why. Okay, the dollar continues to go up. Look at the rise at the very end. So the dollar, you may think the dollar is terrible because it's not backed by anything. It's diminishing in value in absolute terms, you're right. But relative to other currencies, the European currencies in particular and the Japanese currencies, it is strong. So if you're buying things in other countries or traveling or that sort of thing in other countries, the dollar's your friend. Those people in other countries who are coming to the U.S. or who are investing in the U.S., the dollar is not your friend. That black arrow turns around and goes the other way. You are disadvantaged if you're investing in the U.S., but you're advantaged if you're investing or spending money relative to other currencies in other countries. Gold has had an amazing 3 weeks. It's gone up and up, and it continues to go up. You can see that at the very end. It is on a run. How far will it go? I don't know. Gold is a defensive asset. So you say not only is energy up, but gold is up. So when you get gold and energy going up, that is what they call a flight to safety. People who are looking for a safe haven, and those are two of them. When you go over to silver, silver is even more up and has been even more up for the last 3 weeks. You can see the 2 weeks that is the spike up and the continuing spike in this last piece. I mean, it is on a run. And so I don't know how long it's going to continue, but you can see over the past several months, maybe, 6, 8, 10 months, you can see that the dollar, silver has approximately gone down. But now it's taken off in the last couple of months. Then I put my chart on here, silver relative to gold. Silver, when it is more in favor than gold, this line is going to go up. When gold is more in favor than silver, it's going to go down. During the past year or so, you can see there is a lot of up and down. Silver's tried to make a move, then gold tried to make a move, etc. So it's gone up and down. And again, during the past, say, 3 weeks, you can see I put a black arrow on it. You can see that silver has clearly outperformed gold, but it has had a series of back and forth motions. Bitcoin came down a little bit in this last week or two, and you see that at the very end, but the long-term or the intermediate-term direction is more positive for Bitcoin. Volatility, because of the volatility index, the VIX, VIX, because of the charts I've shown you in the past, the number of dots and relative strength and so forth, you can see that equities have struggled. It was a negative week for equities. As a result, the volatility index, which measures the downward pressure in the market, particularly the S&P, spiked up. So it has gone from about 13 up to about 17. Percentage-wise, that's a big jump. So you can see that on the chart. I put a black line up at 24, which is my personal indicator for if the volatility index moves above that, then it tends to go higher, and it tends to enter into higher risk territory. So it has not reached that level. It's not threatening that level yet. I don't know if that's going to happen, but it's a ways away from it. But a quick move from 13 to 17 is indicated by the black arrow. Okay, Asbury Research does metrics, and these are the indicators. Most of them are fundamental indicators, and they tell the direction of the market in general. So you've got 6 of them. All 6 are negative. 0 are positive. If you go back, I think 3 weeks ago, they were all positive. So it has migrated over to all negative. So as of this last week, which was generally a negative week. The cross-asset asset relative performance chart compares one asset or aspect of the market to another. For example, I'll give you the ones that are covered in the last week, the last month, the last quarter. So large cap is stronger in all 3, weekly, monthly, quarterly. Large cap is stronger than small cap. Broad market, the S&P, is stronger than the blue chips, which is the Dow Industrials. Growth is stronger than value, we saw that earlier, and U.S. is stronger than developed markets. Government bonds, stronger than corporate bonds. High yield, stronger than high quality government, and short term is doing better than long term. So then, looking at the U.S. versus the world, there are 2 countries that the U.S. that are better than the U.S., and one is India and one's Peru. All others are mixed, or the U.S. is better. For example, U.S. is better than Brazil, Canada, Mexico, Switzerland, Germany, France, the Eurozone, Malaysia, Japan, Hong Kong, Singapore, South Korea, and China, and the Pacific, and Australia. Other than that, the others are stronger than us, or it's mixed. Okay, so I've done this in the past month or so, took the U.S. market, not the dollar, not the currency, and not the economy, but the market, the ETF, EWL for Switzerland, compared it to the SPY for the U.S. Equity market, and you can see from May of 2023 to present, look at the direction of the U.S. relative to Switzerland. So if it goes up, that favors the U.S. If it goes down, it favors Switzerland. So as a surrogate for the Eurozone, but this is a really good chart, it shows the degree of strength that the dollar has to the market in the U.S. relative to the Swiss market. As I said earlier, gold has been on a run, so has silver. So you can see that this last week, for the entire week, gold went up 0.6% from the previous Friday. Silver went up 1.5% from the previous Friday. The gold-silver ratio has dropped from, it was at one point around 90 to 1, now it's down to 84 to 1. Still favors silver as a better buy. A monster box of silver bullion. This is a silver that's not a silver eagle. It's just generic silver, pure silver. And that monster box of 500 is now $14,530. The markup over spot, I just told you spot, the markup is $1.21. So for 500 of them in a monster box, the cost is $29.06 per round for 500. For 20 in a tube, it is $29.56, a 50-cent higher price. So back to this slide, $27.85 is the cost, the spot price. So $27.85, you add the $1.21 and you get $29.06 for a monster box. Source of the information is my son Preston. Warren Buffett is no fan of bonds / fixed income. Fixed income means bonds. And he said this: bonds are not the place to be these days. Of course, there's never a place to be in bonds, according to Buffett. Can you believe that the income recently available from a 10-year Treasury bond has fallen, think about this, 94% from the 15.8% yield available in September of 81. So from September of 81 to today, a decline of 94%. So in a macro view, his point is bonds are not the place to be. In certain large and important countries, such as Germany and Japan, investors earn a negative return on trillions of dollars of sovereign debt. What that means is, when you earn a negative return, you have to pay them to keep your money. You don't get a return, they charge you a fee to keep your money. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. And I would take it a step further and say this is part of 60-40 buy and hold traditional advisor, traditional investment portfolios. In my opinion, you have to find some way to mitigate the risk of equities, because equities alone are a pretty volatile place for most investors. But using bonds as that method, traditional advisors are bought into it as the only way to do it. But as Buffett says, that combination faces a bleak future. Thank you for watching. If you have questions or comments, feel free to leave them in the comment section below.